What if I told you there's a business model where your customers pay you money for a promise you hope you never have to keep? And the longer you can delay keeping that promise, the richer you get? That's not a scam. That's the entire insurance industry. And once you understand how it actually works, you'll never look at your car insurance bill the same way again. Let's break it down. Here's the basic pitch insurance companies make to the world. Give us a small amount of money every month, and if something terrible happens to you, we'll give you a large amount of money back. Sounds simple. Sounds almost charitable. But behind that simple pitch is one of the most brilliant financial engines ever built. Because here's the secret. Insurance companies don't actually need to make money on the insurance itself. In fact, a lot of the time, they lose money on it. What they're really doing is something much bigger, and it's called float. Float is the giant pile of cash sitting in the middle of the business. Think about it this way. You pay your premium in January. Your house doesn't burn down in January. It doesn't burn down in February either. Maybe it never burns down. But the insurance company is holding your money the entire time, just in case. Multiply that by millions of customers, all paying in every single month, and you get a mountain of cash sitting there, waiting. And that mountain of cash isn't just sitting in a vault doing nothing. It's being invested. Stocks, bonds, real estate, entire companies. The insurance company gets to use your money, money that technically still belongs to you, money they might have to pay back any day, as their own personal investment fund. This is exactly how Warren Buffett built Berkshire Hathaway into one of the largest companies on earth. Insurance wasn't the profit center. Insurance was the funding source. The float was the real business. So let's talk numbers, because this is where it gets wild. Imagine an insurance company collects $1 billion in premiums this year. Claims and expenses eat up $980 million of that. On paper, that looks almost break even, barely a 2% margin. Boring, right? Except that $1 billion didn't just sit there for one day. It sat there for months, sometimes years, being invested the entire time. If that float earns even a modest 6 or 7% return in the market, you're talking about tens of millions of dollars in pure profit. Profit that has nothing to do with how many claims you paid out. This is why insurance companies can survive terrible years of claims and still come out ahead. The underwriting is almost a side hustle. The float is the empire. Now, here's the part that makes this model so dangerous and so brilliant at the same time. The entire business is built on a bet against probability. Insurance companies employ armies of people called actuaries, whose entire job is to calculate exactly how likely you are to crash your car, get sick, or have your house flood. They're not guessing. They have decades of data, entire departments dedicated to statistics, and supercomputers modeling risk down to your zip code, your age, even your credit score. When you sign up for insurance, you're not negotiating with a person. You're negotiating with an algorithm that already knows the odds better than you ever will. And the house, like a casino, is built to win over time. This is why insurance companies obsess over something called the loss ratio, the percentage of premium dollars that actually get paid out in claims. Keep that number low and profits soar. This is also why getting a claim approved can feel like pulling teeth. Every dollar they don't pay out is a dollar that stays in the investment pot, earning more money. It's not necessarily malice, it's math. The incentive structure of the entire industry quietly rewards delay, denial, and fine print. But owning an insurance company isn't a guaranteed money printer. There's a nightmare scenario every insurer fears. The year when disaster strikes everyone at once. A hurricane season that wipes out an entire coastline. A pandemic that triggers claims across every policy simultaneously. These are called correlated risks, and they're the reason insurance companies spend billions on something called reinsurance. Essentially, insurance for insurance companies. They're so terrified of a catastrophic payout wiping them out that they pay other giant companies just to share the risk. It's insurance, all the way down. There's also the regulation problem. Governments watch this industry closely because when insurance companies collapse, real people lose everything: their homes, their health care, their retirement. So insurers are forced to keep enormous reserves on hand, capital they're not allowed to touch, just in case the worst happens. This means the smartest insurance companies aren't the ones that take the biggest risks. They're the ones that master the balance between investing aggressively and staying safe enough to survive a disaster year. So why does this business model keep attracting the world's smartest investors? Because when it's done right, it's one of the only businesses on earth where you get paid before you deliver the product, and sometimes you never have to deliver it at all. Compare that to almost any other business. A factory has to build the product first, then sell it, then hope to get paid. An insurance company gets paid first, invests the money immediately, and only pays out later, if ever. That single flip, get paid now, pay out later, if at all, is the entire secret behind why insurance is one of the most quietly powerful business models ever invented. It's not about predicting disasters. It's about mastering the mathematics of time, probability, and other people's money. So next time you're annoyed about your insurance premium going up, remember, you're not just buying protection. You're funding someone else's investment portfolio. And somewhere, an actuary already calculated exactly how much of your money they expect to keep.